Sage reporting for Kalkine Media. Thanks for joining us and please stay watching for this trending news topic. Pearls of financial wisdom for millennials. If you were born between 1980 and 1996, then you are a millennial. There is an ongoing discourse that the millennial generation is more tech-savvy and is better placed in matters of personal finance. But it is not accurate to say that all millennials are similar. Be it a 41-year-old with several years of experience, a six-figure income, own successful enterprise, or a 25-year-old on the verge of starting a career, struggling to complete the PhD to enter professional careers. Both are part of the vibrant millennial generation. However, the priorities of a 41-year-old and a 25-year-old are different and hence would require different approaches towards securing personal finance goals. On that note, let us discuss a few financial planning mantras which the millennial generation can abide by, irrespective of their ages. A second source of income. One thing that COVID-19 has taught us is maintaining enough funds that can last for months besides supporting us during the emergencies. It also gave us a powerful lesson on why we shouldn't spend on unnecessary items. The pandemic went on to prove that jobs are not permanent and that an economic downturn could eliminate that source of income. So, if a job allows a legal way of securing another source of income, people should grab the opportunity. It could be investments in the equity market, retirement plans, mutual funds, or real estate. In an ideal situation, the money should not sit idle in a savings bank account. The fact that the millennials are good at investments was reflected by the upsurge in the number of investors in the stock market during the period of lockdowns and restrictions. More and more millennials started trading and took the market by storm. They even challenged the fund houses that used to take short positions on a particular stock. A set of millennials, namely Robinhood traders, formed groups and started buying shares in huge numbers, thus pushing the share prices higher and leading to high losses for the shorters. Investments in the equity market involve risk, but at the same time have the potential to compound the invested money if invested for the long term. Likewise, real estate is a lucrative investment decision if the tenure and location of the investment are chosen smartly. Time equals money. The millennial generation has witnessed the IT revolution and has smoothly adapted to the changes in the field. They have more access to information and know how to utilize the information. This generation knows the value of time, which in a real sense is equivalent to money. Investments at an early stage will bear far better results than the investments made at the later stages. There are many applications and tools available online that could be accessed to calculate how much returns can be fetched by investing a particular sum of money for a particular duration. Investments made at the age of 25 years for the next 25 years will bear higher returns with respect to investments compared to those made at the age of 40 for the next 25 years. It is a simple calculation and magic of compounding, which is at play here. At the age of 65, one who started investments at the age of 25 will surely have a better corpus than the one who started at the age of 40. Financial discipline. It's totally logical to say that you should spend less than what you earn. Then it makes sense to wonder, what for do we have credit cards? Reportedly, millennials avoid using credit cards and are aware of the risks involved with credit card debts. In essence, they try to avoid the debt part and show financial discipline when it comes to managing their expenses. Suppose you want to go to a nice and expensive vacation. However, if you do not inherit millions or billions from your parents and do not have such kind of income or savings, it's never wise to take loans or use credit cards for such kind of expenses, as these are not super indispensable and could be planned later times in your future. In such cases, however, one can still retain the joie de vivre by resorting to free virtual tourism and feasting your eyes on a plethora of travel bloggers' videos to feel the vicarious thrill. So remember what Albert Einstein said, imagination can take you anywhere. Moving on, the Great Australian Dream. Owning an abode is an integral part of the Great Australian Dream, and many millennials aspire to have a feeling of ownership. Buying a house involves mortgages, EMIs, and an initial down payment. Yes, you can save on rents, and the price of property do tend to increase with time. But at the same time, you need to take into account the property cost involved. If the property is located in a metropolitan area where prices appreciate every year, then it could prove to be a wise decision. The gist of this point is to always calculate the opportunity cost if you are planning to buy a property on a mortgage. Hopefully this has been informative for you, and this is Sage reporting for Kalkine Media.